Hey guys, everything noticed on here. Got an economic update for this morning, and this is straight out of Canada. This is CIBC.ca. Let me see if I can put it in reader mode here, which is much cleaner. And this is about debt and negative bond yields, negative investment yields, negative interest rates on investments. CIBC sells negative yield bonds for the first time. So apparently this is the first time in Canada. Canadian Imperial Bank of Commerce has become the first Canadian bank to sell bonds with a negative yield. And it had no problem selling the debt, even though buyers are guaranteed to lose money if the debt is held to maturity. These guys are guaranteed to lose money. So this is government debt. They're selling government debt. That's what bonds are. To raise money. They're trying to raise money for the government or whatever. That's what they do. So usually when you buy a bond, you buy a $10,000 bond, and it's you have to leave it in there for 10 years. And if you leave it in there for 10 years, then you get 2%, 5%, whatever the interest rate is on the money. So you get your $10,000 plus the 5% or whatever interest back. Well, in this case, they are offering bonds and selling them that have negative interest rates. So that means you put in your $10,000, you get something less than $10,000 back at the end of 10 years. So the question is, why would anybody buy these bonds? And the answer is because they are secure. Basically, the investors know how much they are losing, so they can at least keep their money safe in government bonds. Even though they're losing a bit of money, at least it's still going to be there at the end of 10 years, they hope, assuming the government is still standing. Or whatever length, whatever period of time the bond requires to get to maturity. And I was reading onwards, and basically what that means is that investors know that there's going to be trouble in the economy. They're showing their hand, if you want to call it that, and they're buying negative yielding bonds because they know the market's going to drop. They know there's more potential to lose a lot more money in the markets than there is in the bonds. So the bonds are still a safer option, even though they are losing money knowingly on this. Now my question would be, why aren't they buying gold and silver? But maybe in terms of cash, maybe it's easier to transfer and purchase bonds than it is to go and buy a bunch of gold and silver and have to store it somewhere if you have $100,000 to buy these bonds with or whatever. I guess that's what they're doing. I don't know why they wouldn't be buying real estate even. But of course, real estate has a big downside as well. Real estate is very expensive right now. And actually, the potential losses on real estate are more significant than even the losses on these bonds. The losses on these bonds are a known item. They know how much they're going to lose over 10 years. Whereas in the markets, in real estate, they don't know how much they're going to lose or gain, for that matter, over the next 10 years. So it's a bit of a wealth preservation, but it's kind of counterintuitive. The bank raised almost $1.8 billion via bond sale of 6-year debt that yields minus 0.009%. So it's losing very little money over a 6-year period, but nonetheless, it is a negative yielding investment. Basically, using investor money to make money on top of it in terms of interest. In this case, people are willingly, like I say, going and taking a loss on their money because they think it's safer than all the alternatives out there. That bodes very badly for the economy. That shows you that the smart money knows something about the economy, knows it's going to tank soon, and they are getting out of the markets. They are getting out of anything that could be very volatile and getting into bonds, because bonds are not volatile. They're locked in for the 6 years or whatever. That means anybody who bought the debt paid $100.054 for the right to get $100 back from the bank in the year 2022. So they've lost, that 5.4 cents basically. Despite the seemingly poor return, oops, I'll go back to that. Come on, reader. The bank had despite the seemingly poor return, the negative interest rates, the bank had no trouble selling the euro-dominated bonds on Monday. The bond sale was 2 times oversubscribed, so 2 times more people wanted to purchase these bonds than were available, which means there are people willing to buy twice as much debt as there was debt available for sale. The bond sale makes CIBC the first Canadian bank to dip into a current appetite for negative yielding bonds, but the lender is far from the only one to be selling investments guaranteed to lose money. According to Bloomberg, there is almost $12 trillion US dollars worth of negative yielding debt in the world right now, much of which has come from governments and central banks that have cut interest rates to record lows in order to stimulate the economy. Excuse me. Low yields may be great for governments, but they are lousy for savers and investors, and that's obvious. And relating to the safe investment, as expected returns on safe assets have diminished, investors have been forced up the risk curve to obtain satisfactory returns, and there's no return on this anyways. But there's a lack of more significant loss. So if the markets drop out, the government is still required to, provide the same return back. They're not going to lose a significant amount more money having their money in bonds, obviously, or the CIBC as a bank. The CIBC bonds are doubly appealing because they're known as covered bonds. That means they are backed by the Canadian mortgages. Oh, now we get into the mortgage backed securities, and that's what caused the 2008 crash, effectively. The poisonous, what do they call them, poisonous or whatever, failed loans in the U.S. That no one could pay for. So investors in bonds have the right, theoretically, to make a claim against those mortgages in the unlikely event the bank defaults on its loans. And of course, banks don't default on loans because they get money printed from the government to back them up. Too big to fail. That's where that comes in. This gives investors two layers of protection, both from the bank's creditworthiness and from the underlying assets, the mortgages themselves. The bonds have yet to be rated by an agency, but they are expected to get a pristine AAA rating for safety and creditworthiness, according to Bloomberg. So what does that mean? It's basically it's a sign that the economy is going downhill, and investors know it, and so they are accepting negative yield bonds, negative investments, negative yield, negative interest rate investments, because it's a form of wealth preservation. They're going to lose money, but at least they know how much they're going to lose. Whereas if you have it in the stock market, they can lose all of it. If you have it in other investments, maybe even mortgages and housing, real estate, you could lose a huge percentage of it, 75%, 80%. Who knows how far it would drop in an economic failure, crisis, whatever, another 2008 event. So this has come to Canada. It makes no sense, but the investors are showing their hands. They know the economy is going to do very badly shortly. So pay attention, guys. I think the smart money is telling us what's going to happen in the near future.